I'm Will Morris, and welcome to Global Tax Talks Tax in 60 Seconds. Here are some things to watch out for in the coming week. First, expect to hear much discussion of the ECJ's decision in the Apple state aid case, an unusually definitive judgment about which I'll say no more. What I do want to look at, though, are some statements made by EU officials and others in the wake of the decision, which point up a difficult dilemma. The European Commission has been saying recently that it wants to increase Europe's competitiveness and attractiveness, and this got a very concrete boost last week by the publication of a report by former Italian Prime Minister Mario Draghi. Amongst the things that he proposed were increased R&D tax incentives for chip manufacturing and design, reduced energy taxation, and the reduction of tax on the labor income of low and middle income earners. He also pointed explicitly to the US Inflation Reduction Act and its incentives to invest in renewable energy as a model. But following the ECJ case, Commissioner Margrethe Vestager, while acknowledging the importance of the EU decluttering and burden-reducing agenda, said, "The Commission will continue its work on harmful tax competition and aggressive tax planning, both in terms of legislative proposals and enforcement." And Pascale Tridico, the new chair of the European Parliament's Fisc or Tax Subcommittee, said, "We now expect the future European Commission to propose legislation that bans all form of tax avoidance and competitive advantages for tech giants and large corporations within the European Union. Our fight for tax justice is at the beginning." Tackling tax avoidance is totally appropriate and right. But if that issue is always at the head of the line, then there is the danger that they never get to competitiveness. And then businesses will read those signals. And as Mr. Draghi said, we have reached a point where, without action, we will have either to compromise our welfare, our environment, or our freedom. Meanwhile, back at the OECD and on our favorite topic of incentives, an OECD official last week was reported as saying that the OECD was working on guidance to make sure that countries did not give businesses back benefits that they previously received as, for example, non-refundable credits. But as, I'm guessing, no country will be silly enough to give a business back the exact amount of extra tax paid as a grant, how detailed will the OECD have to go? And given, to pick a very current example, that people as distinguished as Mario Draghi are recommending R&D tax incentives, why can't the OECD recognize that there will be good incentives and bad ones? Just saying. Anyway, thanks for tuning in, and come back next week so that you stay global tax ready.